Welcome to today's deep dive. We're really thrilled you're joining us today because we are unpacking something pretty incredible.
Yeah, we are. It's a fantastic text.
Right. We're looking at a comprehensive Spanish book called Criptomonedas para Dummies.
That's cryptocurrencies for dummies.
Exactly. Written by Víctor Ronco and Carlos Vallejo Gonzalez. And our mission today is to really just extract the aha moments for you.
Without all the overwhelming info dumps.
Right. Because this isn't just about volatile trading charts or watching a line go up and down.
No, not at all.
We're talking about how we are fundamentally redesigning trust. I mean, we're going to trace the whole concept of money from giant immovable stones on a Pacific island.
All the way to self-executing digital contracts.
Contracts that literally just pay you automatically when your flight is delayed.
It's a massive leap. But to really grasp where value is heading, we have to look backwards first.
Okay, let's unpack this. Because the authors give us a really solid timeline of money.
Yeah, they walk us right through the evolution.
Right from the friction of basic barter systems to using stuff like salt and then eventually to precious metals.
Which leads to fiat currency backed by central banks.
And then into the electronic bank money that you use every day now.
But the core of that electronic money is still rooted in a centralized authority.
Yeah, it's a medium of exchange that totally depends on someone else's guarantee.
And that is exactly where the authors anchor their critique, especially with Víctor Ronco's background.
Right, because he was actually inside Santander Bank.
In London during the 2008 financial crisis. Yes.
Which is just wild timing.
It really is. And the text uses that firsthand experience to expose the flaws of the traditional banking apparatus. Specifically, they talk about fractional reserve banking.
What they call the coeficiente de caja in Spanish.
Exactly, the coefficient of caja. It's the rule that lets banks hold only a tiny fraction of your actual deposits in reserve.
While they lend out the rest.
Right. And when that system fractured in 2008, it wasn't just a failure of money, it was a failure of trust.
The banks wouldn't even lend to each other because the central guarantors couldn't guarantee solvency anymore.
That crisis sparked a desperate need for an alternative. A system that didn't need centralized intermediaries to maintain stability.
And the craziest part is the book goes way back to find a precedent for this decentralized idea, like the Ray Stones of Yap Island.
Oh, the rice stones are fascinating.
Right. I love this part. So hundreds of years ago in Micronesia, the locals used these giant whale-shaped stones as currency.
Some weighing literally tons.
Tons. So obviously, you can't just put that in your pocket. They were way too heavy to move.
So they didn't.
Exactly. They just relied on an oral ledger.
Yeah.
A shared memory across the whole village of who owned which stone.
Even if a stone fell to the bottom of the ocean during a shipwreck.
Yeah, if everyone agreed you still own the sunken stone, you could still spend it.
If we connect this to the bigger picture, that oral ledger is the exact conceptual blueprint for a public decentralized blockchain.
Everyone agrees on the truth without a bank telling them what the truth is.
Right. But translating that sociological idea into a digital space took decades of work.
Yeah, we have to talk about the pioneers from the 80s and 90s.
The cypherpunks.
The cypherpunks, exactly. Long before Bitcoin, there was David Chaum.
The father of digital money.
He invented eCash in the 80s. And he solved a huge issue called the double spending problem using blind signatures.
Because if money is just a digital file, you have to stop people from just copy-pasting a $100 bill.
Right, you can't spend the same digital money twice. Chaum figured out the math for that.
And then you have the ideological side with Timothy C. May,
the author of the Crypto-Anarchist Manifesto in 1988.
He combined that cryptography with the cypherpunk ethos.
Yeah.
Privacy and freedom from government control.
They realized that whoever controls the ledger controls society.
Which perfectly sets the stage for what happens next.
October 31st, 2008.
Right in the middle of the financial meltdown.
The anonymous Satoshi Nakamoto drops the Bitcoin white paper.
And by early 2009, the network is live, and the first transaction goes to Hal Finney.
Okay, so break this down for us, because the book does a great job of explaining how it actually works without the dense jargon. What are the core pillars?
Well, first you have the nodes and the distributed ledger technology, DLT.
Instead of one central bank server.
Exactly. You have over 10,000 independent computers globally. And they all hold an identical updating copy of the ledger.
So to hack it, you'd have to hack thousands of computers at the exact same time.
Which is practically impossible. Then you have the second pillar, which secures the data, hashing.
The digital fingerprint. The book uses a really great analogy for this.
The 27-page contract.
Right. So imagine you have a 27-page contract and you run it through a cryptographic algorithm.
You get a unique alphanumeric code, the hash.
But if you change a single comma on page 14,
The hash changes entirely.
it's completely different. So in a blockchain, every block of transactions contains the hash of the previous block.
It creates an immutable chain.
Oh.
If someone tries to fake a past transaction, the hash breaks.
And the network just rejects it instantly.
Which brings us to the third pillar, the miners and proof of work.
The people running the massive computers.
Right. They act as decentralized auditors. They solve complex math puzzles to validate blocks of transactions.
And that creates a whole new monetary policy.
This is honestly where it gets brilliant. Unlike fiat money, which central banks can just print endlessly,
Whenever they want.
Bitcoin has a hard cap. There will only ever be 21 million units. Ever.
It's mathematically enforced scarcity.
Yes. And it has this mechanism called the halving. Every 210,000 blocks.
Which is roughly every 4 years, right?
Exactly. Every 4 years, the reward miners get for solving those puzzles is cut in half.
So went from 50 Bitcoin to 25, then 12.5.
It makes the system inherently deflationary. The new supply constantly shrinks.
Unlike our dollars, which just keep losing purchasing power.
Right. But to truly own this deflationary asset, you need to understand asymmetric cryptography.
The public and private keys. We have to simplify this.
It's basically an account number and a password.
So your public key is like your bank account number.
Right.
Anyone can see it and send money to it.
But your private key is your password. You need it to authorize anything.
Which drives home the absolute golden rule of the book.
Not your keys, not your coins.
If you leave your crypto on a centralized exchange, you don't actually own it.
You just have an IOU from them, just like a bank.
Okay, here's where it gets really interesting, though.
Beyond just money.
Beyond money, because Bitcoin proved that the technology actually works right. But then projects like Ethereum took it a massive step further.
By introducing smart contracts.
Which is basically just programmable money.
Yeah, it's self-executing code on the blockchain. If X happens, then do Y.
But the blockchain is isolated. It doesn't know what's happening out in the real world.
Exactly. A smart contract doesn't know if a flight took off on time.
So it uses an oracle?
Yes. Oracles are verified external data feeds. They bridge the real world and the blockchain.
And when you put those two together, the real world applications are just mind-blowing.
Let's talk about the insurance example from the book.
Flight insurance. This is so relatable. Normally, if your flight is delayed, you have to file a claim, wait on hold, deal with paperwork.
And half the time, people just give up.
Right. But with a smart contract, you buy the policy, and the oracle just watches the airport's flight data.
If the plane is delayed by, say, 30 minutes, the contract knows immediately.
And it just deposits the payout directly into your wallet. No claims, no paperwork, no waiting.
It's completely frictionless. And you can apply that same logic to the energy sector.
Like the startup charge they mentioned in the prologue.
Imagine you have a house with solar panels and you generate more power than you need.
Normally, you sell that back to the utility company for pennies.
But with a smart contract, your house automatically detects the surplus.
And it sells it directly to a neighbor's house that needs power.
At a dynamic market price. It cuts out the utility middleman entirely.
It's peer-to-peer electricity. That is insane. What about airlines and tourism?
Well, think about frequent flyer miles. The book points out that 60% of those miles go totally unused.
Just sitting in some database.
Right. But if you tokenize those points on a blockchain, they become liquid assets.
Meaning you could seamlessly trade them with someone else.
Or just spend them at a local restaurant while you're on vacation.
The smart contract handles the conversion in the background.
It brings dead capital back to life. And we can do the same thing with real estate.
Fractional ownership. This one is huge for average people.
Because you don't need $1 million to buy an apartment building anymore.
The property is tokenized, so you can buy specific square meters of a building.
Straight from your smartphone. And you can trade it instantly on a global market.
No banks, no massive legal fees, no escrow.
Just absolute liquidity for traditionally rigid assets.
And it even changes supply chains and agrotech.
Integrating IoT, the Internet of Things.
Right. So say you have a delivery truck full of premium fruit.
Or medicine that needs to stay cold.
Exactly. They put IoT temperature sensors in the truck.
And those sensors act as oracles, feeding data to a smart contract.
So if the truck's refrigerator breaks down and the cold chain is broken for even 5 minutes,
The contract automatically registers the violation.
it immediately rejects the shipment and penalizes the transport company.
No lawsuits or arguing over who spoiled the goods. The math just proves it.
And they apply this to luxury goods too, right? Like scanning a QR code on a Rolex.
To see the unforgeable history of its creation and every person who owned it.
It completely guts the counterfeit market.
Because the blockchain provides absolute truth.
So what does this all mean for you when we step back and look at all this?
The core takeaway is that blockchain isn't just a casino for digital coins.
It's a fundamental infrastructure upgrade for society.
It's a shift away from centralized institutions holding our trust and our data.
Toward decentralized mathematics actually guaranteeing the truth.
It's about empowerment.
Exactly. This technology puts the power right back in your hands. It eliminates the middlemen.
Reduces all that friction we're so used to.
And it gives you true, uncompromised ownership of your assets.
But there is a really provocative thought to leave you with here.
Oh yes, I love this part.
If this technology allows us to create perfectly transparent, unhackable systems without a central authority,
What happens when we apply that to the ultimate centralized system?
imagine a future where voting and national elections
Even public policy and governance.
are run entirely on a decentralized blockchain.
Could the very concept of the traditional nation state become obsolete?
If we don't need a centralized authority to guarantee trust, do we need them to govern us?
It's a massive question to ponder. And it's exactly why understanding this technology is so crucial.
It really is.
We want to thank you so much for joining us on this journey through Criptomonedas Dummies.
Yeah.
We hope this deep dive helped demystify the tech and spark some big ideas for you.
Keep questioning the systems around you.
And keep learning. We will catch you on the next one.